Hey gang, Anthony Fontana here. First off, I want to thank you for reaching out to me, through the real estate Facebook group that you found me on. I want to give you a little bit of background about me before I give you any information at all, so you know who you're talking to here. Number one, I've been in real estate since 1979. I bought my first house when I was only 20 years old. By the time I hit 22, I probably had around 6. So I've been in your industry, in your arena, all of my life. That was in 1979, 1980. I sold probably about 300 houses in my life, and I don't know how many I've rehabbed and fixed. I own First Rehab Property Group. I'm a tax accountant and I'm a mortgage banker. So I actually finance people like you that are looking to finance if you're qualified to do that. So this is a very simple video, very straightforward video. And I have some calculations here that I'm going to be giving to you. I can't do this as a Zoom right now, unfortunately. I don't have the time to set up a Zoom and run this that way. I will do that. It'll be a little bit more compact, a little bit more detailed, and I'll be able to bring some written materials to the forefront and maybe some bullet points and things like that. But listen, you can reach out to me and discuss this anytime you like. You will have my phone number right in this video and my email address. Of course, you can reach out to me anytime. So now let me explain a little bit of what I offer in terms of information to my real estate clients. As a mortgage banker, I'm involved with hundreds of realtors on a regular basis. I see them almost daily. I just came back from a couple of open houses. I'm always with these guys, and they're always approaching me on what to do. I do classes for their real estate agencies on this same subject. So let me explain. LLC versus corporation / S Corp. Let's get into this a little bit. An LLC is a limited liability company, as you all probably know. It is an entity. It is something that's established on the state level within your state. I've probably at this point opened up LLCs and corporations in around 40 states. I don't think there's a few that I haven't done any business in at all. It just doesn't come to me. So you have an LLC, limited liability company. Now here's the deal. A limited liability company, it's limited. The liability on the members, you're not a stockholder, you're a member. If it's a single member LLC, a single member means you, then for all intents and purposes, an LLC is recognized only by the state. Federal government, IRS, does not recognize LLCs at all. It only recognizes partnerships and corporations in general. Those two are the ones that you'll be dealing with in any event. So now, an LLC is a limited liability company, member-driven. You have a managing member and you have a number of other members, or you just have a managing member who runs it and he's the only person that's involved. That's usually what people set them up to be. Now, limited liability simply means that as long as you're not using personal funds to run the business and throwing personal money in there to fund your day-to-day operation, you're going to have a limited liability to being sued, to being attacked, to being harassed, to being money taken from your personal life if the limited liability company creates an issue that causes it to be subject to a lawsuit. Now, that doesn't mean you get away with murder. It really does. It's a veil that shields you, but it doesn't shield you 100%. It is limited. If you turn around and do something based on malfeasance, based on fraud, you're going down. The state's going to come in, the courts can come in and lift that veil. If you apply for credit in an LLC's name and you do it fraudulently, it doesn't matter. They're coming after you personally. They will seize your personal assets. That's been done in every state that I've ever looked at. It's a routine. Don't do it. So legitimately running an LLC is a great idea, but it is a limited liability company. It's considered what's called a disregarded entity for IRS purposes. In other words, they don't care that you have a company name. It could be Fontana Properties, LLC. I'm the managing member. I'm the only member. Great. IRS doesn't care. Any number, any money that comes into that company, in that company's name, via either short sales, selling real estate, rent rolls, any other business income, obviously, if you're in wholesaling, all of that, it doesn't really matter. If you're a real estate agent, you're a 1099. All of your money is 1099. It flows to the it flows to the LLC bank account. Well, guess what happens? It's your money. IRS disregards the fact that it is an entity in your eyes. In their eyes, you're the entity. You're the one. So you'll end up paying full boat on this. You'll pay what's called income tax, obviously, based on your tax bracket, your personal deductions, and you'll also pay something very simple that a lot of people don't realize. You're going to pay Social Security and Medicare tax, self-employment tax, at 15.3%. Now, if I just a quick calculation, I'm not going to get into detail on calculating this because it'd be impossible without a calculator. But let's just say, for example, you earned net after expenses, God bless, $100,000. Most of my realtors are at the $250,000 mark, but $100,000 is not bad for a real estate agent. It's very doable, not that bad. Work hard, you'll get there. Let's say that's your net income. After deducting LIBOR fees, MLS fees, Zillow leads, everything, the closing gifts, all the stuff that goes into running what is now your business, your broker fees that they charge you for your desk, whatever they are. There's dozens of them. I actually have a 3-page document that I give to my realtors that I can share with you guys later. So all those, you have $100,000 net income. Okay, how does that work? Well, you're going to pay about $15,000 in self-employment tax automatically. Now, as part of that, you're going to also have the ability to get a qualified business deduction, which is going to reduce the income that you're going to be taxed on the income tax level. You're also going to be able to deduct half of that self-employment tax from your gross income, net of deductions. It's just a calculation. It's not simple to do it here. I'm not going to do it here. Suffice to say, you got a $15,000 self-employment bill, and let's just calculate $15,000 in personal income tax, just off the top of my head, about $30,000. Well, that's the way that works. Now, if you have several members, you can decide how to allocate the expenses, the income, any way you want. That's the flexibility of an LLC. You can change that as you go along. You can decide one guy gets 60%, he gets 40%. This guy gets 32%, the other guy's going to get 68%. It's your decision, and you just simply have to manage it the way you want to manage it. You have that flexibility. You are filing a certificate of organization with the state that you're in. They're going to issue that certificate. You get an EIN number, an employer identification number with IRS, and then you open up a bank account. You're running a business. The fact that it's disregarded simply means this. The pass-through effect passes through from the LLC, pass-through income from the LLC to you personally. You are the company, period. Now, you can elect to run the LLC as an S Corp for tax purposes. That's a filing that we do with IRS, and they routinely grant it. It really depends on the structure, and it depends on if it works for you or doesn't work for you. Most of the time, you can do that. So you get the limited liability, and you get the tax advantages. Here's why I usually suggest S Corps for my clients, my tax clients that I work with on a regular basis. And again, I've been in the accounting industry since 1980, so I've been doing this a long time. I own First Rehab Property Group, like I said, so I'm in your industry, and I face this challenge every single year for the better part of 30 years. So, an S Corp is not an entity. What do you mean it's not an entity? It's an S Corp. It's not an entity. An S Corp is a tax designation which is based on a specific code in the corporate tax code of IRS. Okay, IRS regulation. So we call it S Corp. It's an S Corp. It's a special corp, small corp, has specific requirements to be able to open one up. It has to be a domestic corporation. You have to be a citizen or I guess green card holder, and you have to have no more than 100 shareholders, only one class of stock. So that makes it slightly more complicated than an LLC. Okay, that's fine. Let's assume you have somebody competent working on this for you, usually an accountant. We usually know what we're supposed to be doing for you. So you have an LLC or an S Corp. Which one? The first thing you do when you open up a corporation is you do the same thing you would normally do when you go to your state to open up an LLC. You file a certificate of incorporation with your state. I'm in New York. That's what we call it here. It's different things in other states, but it's the same thing. You apply. 9 out of 10 states will do it right online. You get your printout. You go to the bank with the EIN number from IRS and your ID, and you can open up a bank account, roughly. But here's the challenge. A C Corp is not a pass-through entity. You cannot pass the income from a C Corp to yourself. What happens with a C Corp is it gets taxed at whatever profit it has. If it pays any salary to you, it gets taxed on the net income, but it also pays employment tax on your behalf, and you, of course, pay some employment tax. And you have wages that you have to pay taxes on. So that's how that works. So this double taxation comes in, not from that, but from the fact that to get any money out of the corporation outside of salary, you're paying dividends. Dividends get taxed at the dividend rate at that moment. So you have dividends, you have wages, and you have retained earnings. That's a C Corp. What we usually recommend is we open up the C Corp, and usually within 8 minutes of opening up that C Corp, I've already filed a form with IRS requesting S Corp status. It usually takes anywhere from 3 to 8 weeks to get the request back, but as soon as I send it in, I'm pretty confident that we're getting the S Corp designation. I'm not concerned about that. We get the EIN number immediately. So you have the EIN number, you have the S Corp designation request already in, and you have your certificate of incorporation already done, usually within 15 minutes. You are a live business from 15 minutes after that phone call. You are done. You're ready to roll. You can go to the bank the next day with the documents that you're supplied, and you can turn around and run your business, start making money. Now, how does it work for you? Let's take that same $100,000 a year. Now, this is complex calculation, so I have software that I run for my clients, and I'm going to just run it right over here. I'm going to go to the $100,000 one real quick. If I can find it, here it is. Okay. You've earned $100,000 as a realtor. That's fantastic. Congratulations, you're making money. As an accountant, I would set you up on at least a $25,000 salary. Now, anything you draw out from the S Corporation becomes a draw, which is technically your income. So we usually try to figure out what sweet spot can we be at to provide you with some sort of cash flow from your ongoing closing so that you can be profitable and pay your bills and live your life. Now, we set up a $25,000 salary. For example, in this particular example, I have a $100,000 net income. This is the after-tax income to the corporation before the wages paid to you as the owner. $25,000, let's use $35,000. $35,000 in salary. This is a single filer. This number works. If you are filing as an LLC, here's the way it works out. You have a qualified business deduction of $16,187. You got standard deduction of around $12,000. There's some adjustments to income, which is the self-employment tax, and you have a self-employment tax of $14,130. That's your self-employment tax. Making $100,000, paying yourself a $35,000 salary. Now, the federal income tax is $10,184. Okay, so the after net from the $100,000, you're netting $75,686 from $100,000. Your total cash after taxes is basically $75,686. That's not too bad. $100,000 and you have a $75,000 after-tax take-home pay. Not too shabby. I think most of you would be okay with that, right? Okay. Now let's look at the second way. If we do this as a corporation, the number is actually higher. On a corporation, you have a $100,000 income, $35,000 salary paid to you. You have a $23,000 taxable income. You have $23,000 taxable with SE 5,365. Federal income tax is $2,569, and you have a net cash to the owner $27,000. Now the C Corp is now retaining $51,000. Well, that's a lot to retain, but that's money that's being kept. If you dividend it out, there's going to be taxes on that. But in terms of this one, simply put, the total cash after taxes is $78,000. Now remember, I said $75,686 for the LLC, single member LLC. Let me go to S Corp. This is where it gets fun. It never fails no matter what number I put in. $100,000 in net 1099 income, $35,000 salary, which is just a couple of forms that we file every year for you for payroll. We have a net taxable income from the business activity of $65,000. We have wages again of $35,000. The net result, rather than go through all these calculations for you, is going to be a taxable income of $75,000. You have a payroll tax of $5,365 versus $14,130. You can do the math. There's a difference between $14,130 and $5,355 for a net federal income tax of $12,440 versus $10,164. The net payment to you on the same income, $100,000, $35,000 in wages, is $82,205. Well, what's the difference? That's about $7,000 in taxes that you're not paying because you're not paying self-employment tax on a gross amount of this money. Let's go one more example. In fact, you know what? Maybe I'll do two more examples here to make it clear. Let's go crazy. You're a realtor. A lot of these are new realtors here. But let's say you're a $250,000 realtor, which is my average real estate agent. paying themselves a $60,000 salary, which is, again, a reasonable amount of money. It keeps them under IRS radar. They're usually really good, and it's a nice salary. It's usually enough to pay bills. Now, okay, so again, this is the single payer. I'm not doing joint. It gets crazy. So, $250,000. The bottom line number for an LLC is $172,351. Write that down. $172,351 from someone that made $250,000. That is their total cash after taxes. Okay, now LLC, same income, $250,000, same salary, $60,000. Their cash flow is $192,000. $20,000 in savings. And the reason that happens is because that's self-employment tax. Self-employment tax for the LLC is $22,617, right? But for you as an S Corp, okay, it's $9,180. That's the bottom line right there. I can stop and end this call, end this video right there so simply. I'm going to do one more example, a little bit more reasonable for someone fairly new in real estate, maybe your first year, year and a half. $75,000 income, $25,000 salary. The bottom line numbers are real simple. We have $58,308 for the LLC. We have $63,575 net cash in your pocket as an S Corp. Now the corporate entity is $59,000. So all of these numbers work out in favor of an S Corp. Now, the major difference between the two is it takes a little more effort to organize an S Corp or a corporation and a little bit more paperwork in the course of the year to maintain it correctly. If you have to pay a salary, you have a salary. You can't pay yourself a salary with an LLC because all the income is automatically taxed to you no matter what you do. So the LLC has an advantage that way because you have the paperwork, but between you and me, I'd rather save $15,000, $20,000 a year and worry about a couple of simple forms that any accountant worth their salt can file just like that. And most of us will do that pretty much no charge at all if we're doing your returns. You have two tax returns to file as an S Corp. You have the S Corp return, right, 1120S, and you have your personal return, which is a 1040, plus your state return. So total, there's 4 tax returns done. That's what we do for a living. What I do is I set up the corporations, I get you the employer identification number, I set up the operating agreement, I set up the certificate of incorporation or certificate of operation for the state that you're in. We file it and we get it done for you. And if the state does it online, we have it within minutes. If they do it by mail, it takes you an extra few days to get that document from your state. So if this is a very fast video, I hope it makes sense. I'm simply telling you this. An S Corp is almost always the better way to go. You have the same liability limits as an S Corp. Most of you guys will not have multiple shareholders, but you can sell shares in the S Corp to people that you want to invest in the corporation. And then they become stockholders. You issue stock certificate. You can dilute your own stock a little bit and raise money that way. With an LLC, not so easy to do. If you have 2 members of an LLC, it's considered a partnership under IRS code. However, each individual partner pays his own self-employment tax. If one of those partners vacates, technically the partnership is dissolved. Back to square one. So I don't recommend it. I firmly recommend S Corp. However, in reviewing your personal situation, your personal taxes, we run all of your data through software to make sure we're giving you the best plan of action. And some of you are in LLCs and you want to convert to an S Corp. I can show you how to do that. Fairly straightforward information. So if you got anything out of this, I appreciate that. Send me a direct message on Facebook, and I'll respond to any questions that you have. I'll pass you my phone number. If you want to give me a phone call, book an appointment, sit down and talk about what to do next, how it works. If you want some physical help doing it, I don't recommend you do it yourself, quite frankly, because there's a lot to both. You want to make sure you're making the right decision based on your financial situation. Because I'm going to be honest with you, a lot of realtors have jobs, regular jobs. So you have to couple that. You have a wife, you have a spouse, you have kids. There's all this intertwining going on. As an accountant, we look at the big picture and we figure out what's the best way to go. So if you're an investor, if you're a realtor, if you own a business, which you do as a real estate agent, you want to get the best advice. So this is a very quick video. Hope you got something out of it. 20 minutes in, I'm going to end it right now. Reach out to me, 917-331-9686. I'm on Instagram, which is at Elevating Minds. And of course, Facebook, you see me. I'm Anthony Fontana, the very first Anthony Fontana on Facebook. I think it was 2007, 2008 that I've been on Facebook. So I do a lot of social media, I do a lot of teaching, a lot of classes for you guys. Reach out and chat with me, and hopefully you get something out of this. God bless, and we'll speak to you later.